Breaking news on Martyn Lucas Investor. We are covering the Walmart earnings. So this was made during a live show. If you want to go see the full show, I'll put a link towards the live show below. But in this video, you get to see the full Walmart earnings. You get to see my analysis beforehand. You get to see the jobs data come out as well. And Walmart is a very, very important earnings because we get to see the consumer, how they're spending, the trends, and all of those sorts of stuff. Is tariffs going to come into effect in terms of is it going to be passed through to the consumer, or Walmart going to take the hit themselves? So let's get straight into the video. On with the video. Okay, let me go over to this now. We just gave you all that information, and Walmart is now live. They've got their music playing for now. We'll keep an eye on this. Okay, Walmart earnings is set to start any second now. Then we'll probably pause the Walmart earnings. This is all live. We'll probably pause the Walmart earnings or let it play through while we quickly cover the jobs data, which will be on this screen over here. We're getting initial jobless claims, and we're getting the 4-week average and all of that sort of stuff. It's projected at 225,000. Obviously, the higher the jobless claims, the more likely we are to get a rate cut. So we'll be keeping, sorry, you can't see it right now. Initial jobless claims just above my head over here, 225,000. That's the number we'll be watching in about 30 minutes time. So we'll come back to that as the Walmart earnings plays.
At this time, all participants are in listen-only mode. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. I will now turn the conference over to Steph Wissing, Senior Vice President, Investor Relations. Thank you, Steph. You may begin.
Welcome, everyone. Joining me today from our home office in Bentonville are CEO John Furner and CFO John David Rainey. We'll begin with highlights of the fourth quarter and full year. Then we'll open the line for your questions. During the question and answer portion, we've invited segment leadership to join. Dave Gugina from Walmart US, Chris Nicholas from Walmart International, and Latrice Watkins from Sam's Club US. So we can address as many of your questions as possible, please limit yourself to one question. For additional detail on our results, including highlights by segment, please see our earnings release and supplemental presentation on our website. Today's call is being recorded, and management may make forward-looking statements. These statements are subject to risks and uncertainties that could cause actual results to differ materially from these statements. These risks and uncertainties include, but are not limited to, the factors identified in our filings with the SEC. Please review our press release and slide presentation for a cautionary statement regarding forward-looking statements, as well as our entire safe harbor statement and non-GAAP reconciliations on our website at stock.walmart.com. That concludes my introduction. John, over to you.
Good morning, everyone, and thanks for joining us. I'd like to start by saying thank you to our associates around the world in helping us deliver another year of strong growth. Across markets, our teams continue to demonstrate the power of our omni-channel model. Since the year began, I've visited great stores and clubs in the U.S., Canada, and Mexico. The automation of our supply chain is on track. We're gaining market share, and we have momentum in growth areas like marketplace, advertising, and membership. Looking at our results for the quarter, revenue was up 4.9% in constant currency, including growth in e-commerce of 24%. Adjusted operating income grew even faster at 10.5%. All three segments grew profits faster than sales for the quarter. And we're doing a great job of managing inventory. That's so important in running our business day to day. We ended the quarter with inventory up 2.6%, or about half the rate of sales growth. Sales were strong across each segment of the business, and this includes sales of general merchandise, which grew on a global basis and was up low single digits for Walmart US, led by fashion. Fashion was a bright spot for us both in-store and online. Driving a healthier mix of sales growth in our business is important to the strategy overall, so I'm pleased with the trends we're seeing. Across our customer base, spending continues to be resilient. In the U.S., we see the customer as choiceful in their spending. Again this quarter, the majority of our share gains came from households making more than $100,000. For households earning below $50,000, we continue to see that wallets are stretched. And in some cases, people are managing spending paycheck to paycheck. That said, even these households are emphasizing convenience nearly as much as price. Stepping back, when I look at the enterprise today, it's a portfolio of businesses anchored in growth, especially our digital channels, with an emphasis on having inventory close to the customer to maximize our delivery speed. Our associates have made this vision a reality, and I couldn't be prouder of them. They've been open to change, learn new skills, and they pushed us to keep the customer and the member at the center of everything we do. Ultimately, what matters is how we show up for our customers and members. Did we serve their needs better today than we did yesterday? If so, we did our job. And how we approach getting better every day is what's important to me. We do that by living our purpose and values. That won't change. Our mission, to help people save money and live better, is as true today as it's ever been. It guides the strategy we've outlined, and that strategy is clear, and we're executing on it at a high level. And this includes the allocation of capital, which remains consistent with how we've described it as a percentage of sales. We look at capital spending through the lens of return on investment. Every dollar we spend has to compete for the highest return. Walmart is widely known for value on a broad assortment of items and for being a company that people trust. And thanks to how we leverage our assets for a truly omni-channel experience, we're now known for ultra-fast delivery times and providing convenience. The investments we've made in technology and supply chain help us deliver items even faster. They're paying off. Here in the U.S., customers using fast delivery, and that's delivery in under 3 hours, grew more than 60% for the year. We know that customers and members from around the world are more alike than they are different. They love great quality products, value for their money, and more often, they're turning to Walmart for speed of delivery on a broad assortment. And being people-led and tech-powered helps our associates to find better ways to serve customers and members with our growing assortment, faster delivery speeds, and experiences they love. The way we're using technology and AI is helping us create great customer solutions, reduce friction, simplify decision-making, and pinpoint where our inventory is, all while maintaining the trust we've earned from our customers and members. And we aren't just embracing the tools that are changing the way people shop, we're creating them. We're enhancing our shopping assistants like Sparky and building new experiences with partners like OpenAI and Alphabet that are shaping the future of agentic commerce. Looking more closely at Sparky, we're seeing good momentum. Customer engagement is up, and the customers who use Sparky have an average order value that's about 35% higher than non-Sparky customers. And I love how Sparky perfectly fits within our omni-channel strategy. It connects digital intent to fulfillment through forward-deployed inventory and 1.5 million associates here in the U.S. When Sparky builds a basket, we execute it through fast delivery, pickup, or in-store, turning AI engagement into immediate physical outcomes. And as we expand Sparky across experiences like voice, in-store, and through services, we expect continued acceleration in customer adoption and the impact on commerce. We've started with Sparky here in the U.S., but we know that winning in a connected world means we need to deliver consistent experiences across markets. And to do that, we need to focus on technology platforms that are built for a global business. The idea of build once, scale globally makes us faster, lowers cost, and ensures consistency. And we'll use AI to layer on top of existing platforms, getting better leverage out of the assets we already own. This platform-centric approach helps us scale innovation consistently and reduce capital intensity. As I close, I'll say the pace of change in retail, it's accelerating. It's exciting. For Walmart, the future is fast, convenient, and personalized. And I'm challenging our teams to move even faster as the opportunities with AI become broader and deeper. I feel great about our future. Over the past several weeks, I've talked with associates in Mexico, Canada, and across a number of cities here in the U.S., and I love what I'm seeing. The enthusiasm, the passion, the execution, all the things that make Walmart a great place to shop and a great place to build a career, they've been on display. And I can't wait to get out to more markets in the coming weeks. I'm so grateful for the opportunity to lead a business that has momentum, built on a strong foundation, and with a deeply experienced leadership team. And mostly, I'm excited about what's to come and the plans we have to grow the business as we look ahead. And John David, I'll turn it over to you.
Thanks, John. I also want to thank all of our associates for helping us deliver these results. If there's one thing I want you to take away from this call, it's that our teams are executing well and our business model is delivering strong growth and incremental profits, even in the context of the highly dynamic operating conditions we and the rest of the retail industry are experiencing. We finished the year strong, with a quarter of broad-based share gains, continued e-commerce momentum, and adjusted operating income growing at 10.5% in constant currency, which is over twice the rate of sales growth. The advantages of our omni-channel model and diversified profit streams are increasingly clear. For the full year, we grew the top line by approximately 5% in constant currency, adding $35 billion in revenue, with sales exceeding $700 billion for the first time. And we grew adjusted operating income 5.4%, even with a 300 basis point headwind from increased claims expenses and navigating a bumpy tariff environment. This was the third consecutive year that we grew profits at a faster rate than sales growth. We're playing offense by reinforcing our customer and member value proposition, evolving our model, and delivering on our financial framework. Our strategy is working, and we're excited about the opportunities ahead. For the fourth quarter, consolidated revenue in constant currency increased nearly 5%, with Walmart U.S. comp sales up 4.6%. E-commerce sales were strong across markets, with growth up 24%. We're using our unique assets, stores and clubs, DCs and FCs, and last-mile delivery networks to get orders to customers faster and more efficiently, remove friction from the experience, and accelerate our sales momentum. In Walmart U.S., e-commerce sales grew 27%, with 35% of store-fulfilled orders delivered in under 3 hours. In China, e-commerce grew 28% and represented more than 50% of the sales mix in that market. Flipkart is delivering orders in less than 15 minutes across more than 30 cities in India. And Sam's Club US doubled their growth in club-fulfilled delivery sales. The increase in fourth quarter operating income was led by more than 26% growth in international, reflecting improved e-commerce economics, as well as lapping last year's strategic investments, and nearly 7% growth in Walmart U.S. Several factors contributed to our operating profit growth. First, business mix. As e-commerce drives the majority of our sales growth, we're improving e-commerce economics with increased contributions from business mix, most notably in higher margin areas like advertising and membership fees. Our advertising businesses globally increased 37%, including an acceleration in Walmart Connect in the U.S., up 41%. Importantly, we lapped the acquisition of Vizio in December, so their performance will now be in our base. Consolidated membership income increased more than 15%, reflecting strength in Sam's Club in China, which grew over 35%. In the U.S., Walmart Plus membership income was strong, up double digits, as our core offering as well as newer benefits like our OnePay Cash Rewards credit card continue to resonate with members. Sam's Club U.S. membership income grew more than 6% as members gravitate toward the omni-channel capabilities Sam's offers. Notably, the combination of advertising income and membership fees represented nearly 1/3 of our operating income this quarter. Second is inventory management. Inventory increased 2.6% in constant currency, or approximately half the rate of sales growth for the full year. With our growing 3P marketplace, we can better balance owned and third-party assortment, minimize markdowns, and improve our working capital. Inventory efficiency is also enabled by the tech, AI, and automation in our stores, clubs, and supply chain. In Walmart U.S., approximately 60% of stores are receiving some freight from automated distribution centers, and approximately 50% of e-commerce fulfillment center volume is automated. This enables better visibility into what inventory we own and inventory we can access, and also improved our labor productivity. With the proximity so close to customers, we're increasingly leveraging stores as digital fulfillment nodes to move inventory faster and more efficiently than ever before. When you simplify our model, inventory and labor are our two largest costs. Technology-enabled productivity benefits are critical to our ability to grow our core omni business at lower marginal cost. We're extending these platform benefits from the Walmart US to Sam's US, and we're at the early stages of deploying automation across our supply chain in select international markets. And third, merchandise category mix. This is an exciting one to call out, as it's been many years in the making, particularly in Walmart US. As we lean into lower prices through rollbacks in EDLP and grocery categories, we're helping customers unlock purchasing power for general merchandise. We've worked hard to mitigate grocery inflation, as tariff-related costs lifted prices across many categories. We're seeing share gains in GM, and in fashion, we've had several quarters in a row of mid-single-digit sales growth. Importantly, the strategies that drove our results throughout FY26 are consistent with what we expect to support our financial framework in FY27. First, we have strong momentum across our businesses, most notably in digital. E-commerce sales grew nearly 25% this year and exceeded $150 billion for the first time, with Q4 representing 23% of sales mix. This is up 550 basis points from just 2 years ago. This sets us up uniquely well to serve customers however they want to shop with us, particularly as they adopt agentic commerce solutions. Second, we've demonstrated the durability of our model, especially in complex operating conditions. We're realizing the benefits of our diversified, growth-oriented global portfolio. This has enabled us to grow underlying profits meaningfully faster
Can
than
everyone
sales
please
for
hit
each
the
of the
like
past 3
button
years.
and subscribe? That would
Our
be
advertising businesses globally were up 46% this year to $6.4 billion, and membership fees exceeded $4.3 billion. And many of these initiatives are early in their maturity curve. We have a combination of profit drivers, including automation-related inventory and labor productivity, favorable business mix, and continued expense discipline to support continued investment and to drive faster operating income growth. And third, to orient us to move faster at lower cost, we're now aligned globally to leverage common platforms in tech, AI, and digital businesses. We believe this will result in our growth continuing to come at a much lower marginal cost than what it has historically. Now, I'll discuss guidance. Full year constant currency sales are expected to grow between 3.5% and 4.5%, and operating income is expected to grow between 6% and 8%, with EPS in the range of $2.75 to $2.85. Sales guidance reflects a continuation of underlying business drivers and share gains. It considers our efforts to mitigate food price inflation and the headwinds on sales growth from maximum fair pricing legislation in pharmacy. And we expect e-commerce will continue to be the primary driver of growth, with modest increases from store and club sales across the enterprise. Operating income guidance reflects a higher level of confidence relative to prior year's original guidance that we can deliver growth in the upper half of the range depicted in our framework. Our goal is to outperform this guidance, but we believe it's prudent to start the year with a level of conservatism given the backdrop is still somewhat unstable. We're assuming continued margin expansion driven by favorable business mix, automation benefits and productivity, and less headwinds from merchandise category mix. The business continues to generate strong cash flow, with operating cash flow of $42 billion and growth in free cash flow of 18% in FY26. This provides flexibility to reinvest in the business while at the same time returning significant capital to shareholders. Given our confidence in the ability to continue to generate strong cash flows and consistency in our multi-year capital investment plans, our board authorized a $30 billion share repurchase program, our largest to date. For FY27, we expect capital expenditure levels to be approximately 3.5% of sales. We're hitting the peak of annual spending levels on supply chain automation and store remodels. We're moving quickly on these projects as we see benefits to customer experience, business performance, and financial returns from these investments. Investments in AI are incorporated into our assumptions for capital spend. And as you've seen from the announcements we've made, we're approaching AI development through partnerships. This lets tech companies do what they do best, develop innovative technology. And it provides us clarity to do what we do best, to translate the best of tech to retail experiences that create value for our customers and members and our enterprise. In Q1, we expect constant currency growth in sales of 3.5% to 4.5% and operating income of 4% to 6%, with EPS of 63 cents to 65 cents. Q1 operating income growth is expected to be lower than any other quarter in FY27, due in part.
Okay, so we are covering the Walmart earnings currently. If you haven't hit the like button, please do. We do have a poll running in the live chat as well. In 10 minutes' time, we're getting jobs data, so we'll switch to jobs data in 10 minutes' time. So do stay with us. Walmart did miss, they beat on earnings, but their guidance wasn't what the market wanted. But during this call, we can see Walmart trying to make back some of those losses. So let's continue listening in.
Income growth in Q1. For the full year, we would expect an approximate 70 basis point benefit to sales and an approximate 120 basis point benefit to OI. With that, we're ready to take your questions. Thank you.
Thank you. We'll now be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants who are using speaker equipment, it may be necessary to pick up the handset before pressing the star keys. Thank you, and our first question comes from the line of Simeon Gutman with Morgan Stanley. Please proceed with your question.
Hey, good morning, everyone. Hey, John. I want to ask you, John, on agentic commerce. You mentioned it, and it's rapidly reshaping e-commerce as we speak. Realize a lot is still to be determined. I want to ask how you're thinking about, first, customer traffic flows and loyalty related to agentic, and second, advertising and monetization.
Yeah, good morning, Simeon. Thanks for the question. So, first, I just want to say thanks to our associates for a great quarter. They've been executing at a very consistent level with a clear strategy that's omni. And as it relates to your question, agentic is definitely a part of the omni strategy. I mean, our omni strategy, what we've been saying for a long time and building to, is the ability to deliver what customers want, when they want it, and how they want it. And the flexibility that we've built on the backside of this, which includes our fulfillment centers, our distribution centers, our stores, forward deployed inventory, those are all parts of the solution to deliver. What agentic is doing for us, and we can talk about this in a couple ways, but I'll talk about Sparky first with our own agentic agent. Sparky is going to be and is fastly becoming, as it learns new skills, a way that we can understand customer intent better than we've been able to understand it before, generate solutions for them, and then deliver with speed. You heard earlier that our fast delivery was up 60% year on year. Walmart's getting faster. Sam's Club is getting faster. We're able to scale these platforms to international markets. So our ability to understand customer intent, generate them solutions, and deliver quickly is really exciting. So in the quarter, what we saw is that customers who engage with Sparky, we saw an average order volume, or order value, I should say, about 35% higher than the customers who weren't using it. What's also exciting is we had a really high number of customers who are now engaging with Sparky quarter over quarter. But a lot to come here. Agentic commerce.
Can someone tell me what Sparky is? I'm not from the US. I haven't gone to Walmart. I have no idea what it is. Someone let me know what it is, please. Thank you.
Dave, do you want anything on Sparky in the quarter?
Absolutely. Thanks, John. And good morning, Simeon. As John noted, AI is increasingly embedded across Walmart. It's strengthening our operations, it's improving associate productivity, and it's enhancing the customer experience. And that's really coming to life with Sparky. Sparky is essentially helping us evolve from traditional search to intent-driven commerce. And as John noted, we're seeing strong engagement. Roughly half of our app users have used Sparky, and when they use Sparky, it drives them to build bigger baskets. And John mentioned the 35% higher average order value. And what that's telling us is that it's helping customers convert with greater confidence. And I want to note that it is still early in this space, and we're continuing.
Interesting. Thank you for letting me know. It's an AI shopping help. Sparky is an electrician. Yes, in the UK we call electricians Sparkies. So can someone tell me, if you've used Sparky, is it just a gimmick or is it actually good? What does it let you do? Is it actually good or is it just a gimmick?
Continuing to add capabilities, more personalization, deeper contextual understanding. We're building execution capabilities. And I'm excited about the future for Sparky. And then for this group in particular, from an economic standpoint, better discovery
Martyn likes
and higher
Sparky.
conversion translates into bigger baskets and greater frequency. So simply put, Sparky is helping customers find the things they need, they want, and they love. And it's strengthening our digital unit economics as it scales.
So, Simeon, on the second part of your question, then you asked about advertising as well. We had a really good quarter in advertising, up 37% around the world. While Walmart Connect in the United States was up 41%, which is a very strong quarter. So, how this will work with agentic commerce, I think we're all learning as we go, and we'll figure that out. But what we do know, and is clearly happened in the quarter, is our ability to connect suppliers and sellers with a groups of customers who are interested in their products is working, and our capability to do that is getting stronger.
Our next question is from the line of Michael Lasser with UBS.
Is it good or not, guys? Let me know.
Good morning. Thank you so much for taking my question. Last year was obviously marked by a number of unanticipated costs that impacted Walmart's profitability, such as tariffs, the liability expense, and others.
Well, here we
How
go.
did
Tariff.
you factor that there could be other unknowns into your outlook this year? What could those be? And if they do not occur, how would you frame or quantify the potential upside? And along those lines, how would you quantify the degree of reinvestment that you've embedded in your outlook for this year? Thank you so much.
Michael, this is John David. I'll take that. Let me give a little bit of context to our full year guidance, which I think will speak to your question. If you rewind and you look back over the last 3 years prior to this one, we've increased our guidance, effectively increased our guidance if you adjust for the Vizio acquisition, each of those 3 years. And each of those years, we've outperformed that guidance, in some cases with operating income by several hundred basis points. And in fact, if you were to adjust for claims being somewhat anomalous last year, we'd have the same performance in this most recent year. So as we sit here 1 month into this new fiscal year, very much like in past years, we're taking a measured approach with the outlook. There's nothing that we've seen among consumer behavior or KPIs, macroeconomic KPIs, that would make us be any more cautious than what we have been. But I think it's prudent to be somewhat balanced. We are, I think overall constructive on the economy, but there are certainly indicators out there, whether it be a hiring recession or maybe subdued consumer sentiment,
Jobs data in 3 minutes. We'll be covering it live on the show.
that would make you want to be more balanced as you sit here at this point in time. And we've been very fortunate to be able to take a very long-term perspective with the way that we manage this business, to do things that are best for customers. And I would argue that is translated into what's best for shareholders as well. So said maybe slightly differently, we want to maintain maximum flexibility as we sit here at this point in the year. And it's no different than the posture that we took in prior years. So the guidance that we've given, which at the upper end of operating income is 8% on a currency neutral basis, over 9% if you on a reported basis, we're excited about. Like we see the momentum in our business. Each year has gotten better than the last, and we've outperformed that. And we would certainly expect to do that this year as well. But I think given that we are as large as we are and so tied to consumer health and the economy, we want to maintain maximum flexibility and not get out ahead of ourselves at this point in the year.
Our next question is from the line of Greg Mellick with Evercore ISI. Please proceed with your question.
Thanks, Susan. I've just
Hi,
read your
thanks.
response.
I wanted to get a little deeper into disinflation. I think it was up a little over 1% this quarter, and maybe that was down a little bit sequentially. Can you just help us understand in your guide what you're expecting from inflation or particularly disinflation, especially with drug prices coming down?
Sure, Greg. This is John David again. I'm happy to take that. The most recent quarter, we had like-for-like inflation that was trending a little bit above 1%. That breaks down into food inflation being a little bit less than that, GM inflation being a little bit more than that. That's generally what our outlook is for the next quarter and the balance of the year. There are some pressures. You mentioned one, the maximum fair pricing legislation around drugs. We expect to contribute to about 100 basis point headwind for the full year. Within the most recent quarter, having only 1 month of that is about 30 basis points. So the health and wellness business continues to do really well and have strong comps, but that's a headwind that it will face for the year. Generally speaking, we would expect the price levels to, somewhat be in the range that they are right now. We're excited about some of the commentaries that we've heard from suppliers focusing on lower prices, but that
we are very close to jobs report now.
Everyday low prices is what we stand for. We've seen, as we've leaned into these lower prices, that consumers have responded, and we've continued to gain share among all income demographics. I might point out, notably, probably skewed more towards the higher income demographic, but we're going to continue to play offense.
Okay, let's pause that for a second. Let's go over to our jobs report breaking news. Here we go, jobs report.
We've got futures a touch softer, down by 1/3 of 1%. We are seconds away from getting some jobless claims data and more. We'll get to that in just a second. The Nasdaq is negative by 0.5.
Lower than expected.
Walmart trading a bit softer in the pre-market, down
lower
by between 2 to 3% off the back of a conservative guide from that company. That company, the stock, until
let's
recently,
look how the markets react.
All-time high. In the bond market, 2s, 10s, 30s look like this. Yields drifting higher at the front end of the curve. 2s higher by 2 basis points to 347 as the data pours in. Mike McKee has more. Hey, Mike.
Very interesting morning, John, with lots of data. As you mentioned, jobless claims come in a big drop, 206,000 for last week. That's down from the initially reported 227. Continuing claims are at 1,869,000, slightly up from 1,862,000 in the initially reported last week's figures. We also have trade numbers in. The trade deficit for the month of December, $70.3 billion, significantly higher than the $53.0 billion reported for the month of November. Add into that wholesale inventories up 0.2 and retail inventories flat on the month. Those are not particularly great numbers, and this matters because these are the last 3 data points that will go into fourth quarter GDP that we will get tomorrow, and that trade deficit is going to whack away at some of the strength we have been seeing in that Atlanta Fed GDP Now number. The other thing that we want to look at is the Philadelphia Fed. The Philadelphia Fed Business Index comes in at 16.3, up from 12.6. The new orders index is at 11.7 versus 14.4, so that's down a little bit. And prices paid 38.6 from 46.9, so a little bit better business in the Philadelphia area, but inflation drops, and that'll be seen as good news by those on the Fed who yesterday were talking about rate cuts as opposed to rate increases.
Mike, we'll spend some time on the jobs data in just a moment, but this trade data seems pretty wild.
He got that wrong. He meant rate hikes instead of cuts.
Have you got a read on what's driving this?
Well, exports were down by $5 billion from the prior month, and imports were up by $12.3 billion. That's the reason we see that big change. Interesting on the imports, we also have to figure that has a price impact down the road if we're bringing in that many imports. Does subtract from growth,
this isn't
so not particularly good news.
Awful news, but it's not good at all.
How does it affect inflation if many of those goods are tariffed? We just don't know yet. We will find that out as we go along.
Mike McKee, thank you, sir. Some of this can be very, very noisy. I'll pick out a headline because there is a political story in this, and it's goods exports to Canada, the lowest since January 2022.
Yeah, that caught my eye as well. Is this a tariff story? Is the fact that we've been talking about this, what we've seen in Canada is that they have not liked this aggressive push from this administration when it comes to trade, calling their former prime minister a governor, and are they just deciding to boycott U.S. goods? Good exports to Canada, lowest since January of 2022. That's shocking, given the fact that this is our neighbor to the north where, think about vehicles. even to make a vehicle, goes across the border about 6 or half a dozen times. So this is really something very interesting when you look at the trade data coming through.
We've still got Mike McKee with us. Mike, I want to come back to you on the jobless claims numbers because that's a big downside surprise at 206, put together with an upside surprise we saw on the payrolls report. I just wonder, Mike, from your perspective, whether we can put a bit more weight on this idea that things have stabilized in the labour market and maybe even they've started to improve.
Unfortunately, what we're looking at is a lot of secondary data right now, so it's kind of hard to say one way or another. Obviously, with claims where they are, it does suggest we're not seeing mass layoffs. The Philadelphia Fed Employment Index, though, falls to negative 1.3 from positive 9.7. So there's evidence on both sides of the argument that the labor market is at least fragile, if not falling, if not getting into trouble. But then you have the growth idea that things are picking up a little bit. So, the Fed is probably balanced about as well as it can be, given the numbers on both sides of the
rate
argument.
cuts.
Mike, should we be happy with 206 or should we discipline economists for expecting 225? What do you think?
Well, I think if you discipline the economists, you won't get as many estimates next month, and so it won't be quite as valid. So let's stick with letting them do their job and be wrong. It's a possibility.
Why not? Mike, thank you, sir. Appreciate it. Mike McKee with the economic data. Nita Richardson of ADP needs no discipline. She joins us now for more. Nita, good to see you.
Great. I'm glad to be exempt from that.
You should be. Everyone should be. Let's talk about this data. How tight is this labour market?
It's tight, but I'd like to turn our attention away from the hard data and the payroll data, because I think what we've done at ADP is capture sentiment, and that sentiment kind of underscores what's going on in the labor market. So we track workers every month, and what used to be a very optimistic workforce is starting into this really discontent workforce. In fact, that survey suggests that we've gone from stability to a feeling of stagnant. And that is what I think is underscoring the labor market trend. The workers are picking it up. This is a stagnant labor market where most of the job gains are coming from one sector. We're not seeing it broad-based, and I think that is spilling over to how workers are feeling about their opportunities.
So just healthcare and a bit of education,
healthcare.
Is that it?
That's pretty much it. And it's been that way for, the better part of the year, more than a year. We haven't seen this boost that is widespread. In pockets, we've seen leisure and hospitality or financial services, but it's yet to be sustained consistently over a 12-month period. Only healthcare is delivering.
So I'm always interested in job switchers.
Okay, what we're going to do is pivot back to Walmart earnings there. We just got some jobs data, a little bit worse than you want for rate cuts, and it does back up what we saw at the Fed minutes yesterday. Stronger growth, lower unemployment. Again, that doesn't paint the picture for rate cuts. But again, as we've said many times, these always get revised. So you can't put too much weight on the jobs claims, apart from the fact it does affect the market as the numbers come out. Let's go back to our Walmart earnings. Because this is the second most important earnings of the season, in my opinion, the first being NVIDIA. This gives us a lot of insights into tariffs and consumers.
Impressive. What do you see ahead in terms of how the business model continues to evolve and densification? And as we think more broadly about retail on the topic of personalization and moving from predictive to prescriptive with the aid of AI, what are your thoughts for what will happen with personalization, particularly as you see so much interaction with Sparky and have a lot of veracity, volume, and velocity of data? Thank you.
Hey, Oliver. Great question. John David was just alluding to many parts of what we've built to try to serve customers any way they want to be served, where they want to be served, how they want to be served. And that's really the center of what we'd call the Omni strategy. This would include our stores, our e-commerce business that's pure fulfillment. We have our stores that are delivering. We have a mix of all the above. And it's really all designed about channel flexibility. And what we've been saying for a few years
now
is that channel flexibility has been, and again in this quarter, has helped us meet new customers, serve new customers, grow with customers that we haven't been transacting with in the past. So it's really encouraging. But all these pieces have to work together in order for this all to come to the point that we can have results like we had in the quarter. So the best way to say it is if you look at Walmart on the top line and you look at Walmart on the bottom line, those are where I would encourage you to just hold us accountable, because we have a great team here with a lot of experience that can manage the pieces in the middle, ultimately driving at faster delivery speeds and more intuitive experiences so that customers can trust us to be a great place for a great assortment and great prices, delivered the way that they want it to be delivered. And what we're seeing with Sparky, and it's early days with agentic commerce being live in the site, but the quarter was really encouraging. We had a lot of growth from Q4 over Q3, a lot of engagement. Dave mentioned earlier about half of our customers did engage with Sparky, and when they do engage with Sparky, we see better order values. And we had a 27% growth rate in e-commerce in the fourth quarter, which is a big quarter for Walmart US, 24% globally. Sparky is only live in the U.S., but we have hope and ambition that
Walmart
quickly we can expand these platforms into other markets, and I think that will be creative in those markets. But what Sparky can do is it can help understand really clearly what it is that you're trying to accomplish in your life, whether that's a birthday party or a camping trip or planning meals for the week or just planning dinner for this evening. And then we can generate you great, unique solutions real time if we need to, or by knowing you a bit better than we did in the past, we can help suggest things to you that are more in line with your own personal preferences. So all this put together, we believe, is a great way for customers to be able to trust that Walmart will save them time while shopping, save them time in the transaction, but also save them time in delivery. A large number of our orders now we're really proud of are now happening in less than half an hour. We're averaging under an hour in our express delivery when customers choose that. And then, as we mentioned earlier, for our express delivery, our total fast delivery, which under 3 hours, we grew 60% year on year. So when you put it all together, we're confident in the strategy. We like the assets that we have in place. We'll continue to invest our capital in a disciplined way that provides returns, but ultimately drives great customer experiences over the long term.
Wow, wow, wow. Look at Walmart flying now up 4%
Next question
an
from the
hour.
line of Kelly Bania with BMO Capital Markets. Please proceed with your question.
Good morning, and congrats to all the promotions across the segment leaders as well. Wanted to talk a little bit about advertising, $6.4 billion now. I was wondering if you could share with us just any color on what kind of growth you are planning for here. It's been very strong. Should we expect that to moderate a little bit? I know the U.S. really accelerated this quarter too, and maybe you can talk a little bit about what drove that.
Walmart is green on the day. What a comeback.
Of advertisers or categories that are accelerating there, and where do you feel you're still kind of under-penetrated or over-penetrated, and just trying to think about where that could go from here.
Kelly, this is John David. I'll make an attempt at that. In terms of what to expect on advertising, you are right in terms of what you're applying. You get to a law of large numbers where it gets more challenging to enjoy those same growth rates. But in terms of overall progress that we're making with advertising, I really don't see that slowing down. Some of the areas that we've really expanded in are areas like our marketplace business, where we're seeing more of the growth come from that part of the business versus some of the first-party brands. The other thing I'll point out is the Vizio acquisition. We saw triple-digit growth in advertising with our Vizio business in the quarter. We've talked a lot about this. This is exciting because it gives us yet another channel to market to our customers. And I feel like that's really just getting started. Obviously, the base there is not as large as the overall U.S. business, but has a whole lot of runway. As we've talked about in the past, and I know you're very familiar with, Kelly, if you measure us advertising as a percent of like the addressable market or our GMV.
Wow, look at this comeback
we still
for
have
Walmart.
a long ways to go here
God.
to get in the neighborhood of some of the best-in-class competitors here. And so we feel like we can improve our own advertising capabilities while doing it on a growing base, which gives us a lot of runway into the future.
Kelly, you mentioned the team, and I'm really proud of the promotions here at Walmart. Dave Gagina, who spent most of his career in e-commerce and logistics, Chris in businesses all around the world, and Latrice Watkins, 27 years, and the majority of that in merchandising. They're going to do a great job.
$1 trillion company up 6%
There was a structure
in an
change
hour.
that we made
crazy.
in January, which is also really important. And I think that signals confidence that the capabilities we have built in the U.S. are exportable to other markets, and we can work with our other markets to accelerate these platforms to grow. And so that change with Seth Dallaire included the marketplace, Vizio, advertisements, our data services, and Walmart Plus being moved from inside Walmart U.S. to an enterprise role where we can build these platforms once, scale them globally. So we're optimistic that what Seth has done here in the U.S. with his team can accelerate growth in other markets additionally. So John David said it well. This is a big business that's growing, but our share is relatively low compared to what it could be in terms of the addressable market.
And we've just got Walmart. Let me just make sure it's live. Yeah, we've got Walmart up 6% in an hour. That would mean it's a $1 trillion company. So that would be essentially XRP's market cap has just, that's XRP, all of XRP's market cap has just been added to Walmart in the last 1 hour. That's the extent of this move we're seeing right now.
Will be as a result, given we know that the margins are better in stores versus e-commerce. Thanks so much.
Hey, Corey, it's John and Dave and I'll take this one together. As you step back and just think about the Omni strategy, the role of stores, the role of the app, and how they work together, it's just important to remember that stores are a huge part of the solution to deliver the customer experiences that the customers are looking for. Having inventory, and I'll talk about the U.S. and globally just here in a second, having the U.S. with 5,200 locations between Walmart and Sam's where inventory is forward deployed is really helpful, and that's great for a customer who wants to shop in a store, pick up at the curb, or have delivery and do it in a very fast way. We have strength in international markets as well. Places like China has had record deliveries from the clouds and Sam's Club for the season and Chinese New Year. That's also true in other markets in Mexico and Canada where I visited in the last few months. So stores are a really important part of it. Now, how a customer wants to shop, that is completely up to the customer. It's pretty typical that you'd see in the holiday time frame people leaning on delivery more. We had really great experiences and great results in November with Thanksgiving. More and more customers chose to have their Thanksgiving meal delivered. And then this recent ice storm we had in the United States, we also saw a significant number of customers looking for delivery services, much higher than the year before. So whether people are shopping at the counter, they're shopping at the curb, they're shopping in the store, we want to be there for all of them. In terms of the mix and the impact of the P&L, getting to where we were last year with e-commerce moving to profitability, the growth of advertisement, the growth of the other services, we like the way our P&L is set up in terms of providing mix over time. Again, we'll manage that really well. We have a great team of people who do that. So again, excited about the top line growth, excited that our operating income grew faster than our sales in all three segments. And I'm also very confident in the guidance that John David talked about. So Dave, do you want to talk about remodels and investments in stores?
Yeah, absolutely. As John mentioned, we're focused on serving customers how, where, and when they want to shop across stores, pickup, and delivery. And our e-commerce growth of 27%, is leveraging our physical footprint. So this is an interconnected system. So we are making further investments in our store network as a result in that physical footprint. Over the past 12 months, we've opened 12 new stores and we've remodeled 674 stores. Our investments in both of those areas are outperforming plan, and I think that just reinforces the strength in the omni-channel model.
The next question is from the line of Edward Kelly with Wells Fargo. Please proceed with your question.
Hi, good morning, and thank you for taking my question. Impressive progress in e-commerce again. I was hoping that you could maybe update us on current profitability and how you're thinking about 2026. And then as it pertains to all this, you mentioned, pace of change accelerating, competition in e-com, certainly seems to be intense. Can you maybe just touch on, what Walmart needs to be vigilant on to sustain share momentum? And does this impact at all the near-term profit path for the business?
This is John David. I'll start with the e-com profitability. Ed, we've reached a point where we don't even really talk about this internally anymore. We've far surpassed the break-even level. We were profitable in each of the 4 quarters in the U.S. segment, and the momentum is only upward from here. We've been enjoying roughly double-digit incremental margins in e-commerce. We don't expect that to change. We feel really good about the plan going forward. And as you know, the nature of this business is you build a large digital platform and the marginal cost of growth is very low. You don't have to continue to build that platform to achieve the next percentage point of growth. And so we're enjoying the scale economics that come from a digital business. That's not going to change. And getting to the second part of your question, we're seeing that is resonating with our customer and member base. We continue to gain share, and I think a big part of that is convenience. It is the fact that we can serve 95% of America in 3 hours. There are very few people that can do that. And as John and Dave noted, in some cases less than 30 minutes. But it's not just convenience. I'll point you to fashion as an example. Like, we've had several consecutive quarters now of fashion growth in the mid-single digits. I'd argue fashion is not really a convenience item. It shows that our broader assortment is appealing to a much larger customer base, and they're coming to Walmart in many cases, some of them for the first time, and they're enjoying an experience that makes them want to come back.
Yeah, these platforms that we put together, they work at Walmart U.S., they work in other businesses. Sam's Club is an example, obviously a category or a channel that's focused on curation and quality. But Latrice, maybe you comment on the experience your members are having with the delivery platform as we have scaled the platform from Walmart U.S. to Sam's.
Sure. Good morning. Thank you, John. I am a merchant, so this is what I love. I love to talk about how we give members access to products, and you've said it, however they want to shop with us. So a couple of things are happening at Sam's Club. We are leveraging the platform that is what we've created as part of Walmart. And what we're seeing from members who choose to shop with us from home on our app is that 60% of our members can get delivery in 3 hours. So we're growing that. We won't stop there at the 60%. We are growing our ability to give members their items quickly. For members who want to come in club, they love Scan and Go. So Scan and Go is a seamless way for members to get the items they want, get checked out, use our exit arches, and have a frictionless experience fast. So in the spirit of what members want and what they need, they want items and they want to get through our clubs quickly, and Scan and Go gives them the opportunity to do that, and delivery from club gives them the speed that they want.
The next question comes from the line of Chuck Grom with Gordon Haskett. Please proceed with your question.
Good morning, everyone, and good luck, John, as you embark here. Could you talk about the health of the U.S. consumer across income cohorts at this point in time? Any surprises this past holiday season? And looking ahead, when you look at the baskets of GLP-1 users, how has their shopping behavior changed in terms of frequency and basket size? And I guess, how does that influence your planning of inventory in the coming quarters and years?
Hey, Chuck. In the earlier comments, we talked about the consumer in the U.S. We had a lot of growth with customers who are income bracket of $100,000 or above. And that's pretty consistent with the last few quarters and the way we've talked about it. So I don't think there's any big change. I think the way we describe our customers is very thoughtful, they're choiceful, and the lower income segment, 50,000 and below, we did see, of course, as we mentioned, some stress. In many cases, we see people living paycheck to paycheck. In the fourth quarter specifically, there was some sales impact early on that was driven by benefits during the government shutdown that affected Walmart U.S. and Sam's in the United States. For the most part, in Walmart U.S., that recovered as the quarter went on. There seems to be some impact to Sam's over time. On the pharmacy business, the biggest change that would be notable would be the MFP pricing changes on branded drugs. The remaining categories have been pretty consistent over time, and we did provide some comments and guidance about what kind of impact we think that MFP will affect us by. As far as categories around the store, digitally and physically, we're always watching changes in subcategories, what's growing. Our team starts every Monday talking about customer experiences and unit growth in particular. So as we enter or potentially enter a period where inflation is lower or higher, it doesn't really matter to us. We'll manage the commodities as they come through. We'll focus on the lowest prices we can focus on. We had 6,200 rollbacks in Walmart U.S. this quarter, up about 23% from a year ago. So we'll just continue to focus on low prices, but as categories shift, categories grow or they slow, our team will be very reactive in terms of being able to be ready for customers wherever they're looking.
Yeah. And on GLP-1, I just some of the impacts that that we see to our business are as you would expect. So as an example, we see that fresh is a big driver, one of the big things in baskets. The unique thing about fresh is that it's a basket driver. When someone buys fresh items, the baskets tend to be larger by a double-digit percentage. So when you take all of the puts and takes related to that, it's kind of a wash. It isn't a big driver of our growth one way or the other.
The next question comes from the line of Joe Feldman with Telsey Advisory Group. Please proceed with your question.
Yeah, thanks, guys, taking the question. And congrats to all the new business leaders. Actually, it's more for you guys. I was just curious. I know there's three of you, but your maybe brief thoughts as you take over your new role, what you guys see with fresh eyes as you kind of enter each of the divisions you've taken over. Thanks.
Hey, Chris, you want to start with international?
Yeah. Hey, Joe. So, I'm thrilled to be in international. It's kind of a homecoming for me because I started out in international when I joined. And, if I think there's lots of words you could use to describe international, but if I was to choose one, it would be growth. I think growth of the top line, growth in the bottom line. There's so much opportunity globally. And as we think about all of the words we've used today, build one, scale globally, AI helping accelerate that, a platform-centric approach, the ability to take the magic of the culture, great assets that we've got internationally and leverage platforms gives us the opportunity to do something we haven't been able to do before.
Good morning, it's Latrice. I am thrilled, also a homecoming, to be back at Sam's Club. And what I've felt in the time there is the energy and the momentum of the business, both with our associates and with our members. So being in clubs with members and associates has been a thrill. We can see how they love items. We can see how they love to shop. And I'm excited about the opportunity to serve them the way they want to be served, with great merchandise at great value, as fast as they want it, either from our clubs or as they use the mechanisms we have in the club.
Thanks for the question, Joe. First, I want to take the opportunity to thank the Walmart U.S. associates in our stores, our supply chain, our home office for delivering a fantastic quarter. Walmart U.S. achieved 4.6% comp sales with profits growing faster than sales. As John mentioned earlier, I've spent the majority of my career in e-commerce and logistics. And, one feeling I've had the last few weeks is I'm humbled. I'm humbled to learn from and serve 1.5 million associates across Walmart U.S. And I am energized by what I've seen in my first few weeks. I've been in stores in California, Texas, Florida, visited a distribution center in Florida that is delivering fully palletized loads to all of the over 120 stores that it serves. And then last week, I was with the Walmart U.S. leadership team at the year beginning meeting. And what's clear to me is that we are operating from a position of strength, and the opportunity ahead of us is significant. We're investing with confidence in automation, new stores, remodels, our marketplace, membership, advertising, and all of this will strengthen the customer experience. It's going to drive productivity. It's going to improve our economics over time. And I am excited about the runway ahead.
Thank you. The next question is from the line of Rupesh Parikh with Oppenheimer. Please proceed with your question.
Good morning, and thanks for taking my question. So I just wanted to go back to membership income. So we saw another quarter of strong double-digit membership income growth. So just curious, as you look towards this fiscal year, just overall confidence in sustaining the momentum. And I recall last quarter, you guys were very happy with Walmart Plus signups, including some on the credit card side. So just curious, just overall on Walmart Plus, whether any additional surprises as that program continues to ramp. Thank you.
No surprises, Rupesh. In fact, I'm really pleased with the fourth quarter. John David mentioned the credit card offer. You asked about that. That's been strong. Really pleased with the number of signups. The usage rate of the benefits has been fantastic. One of the fastest growing benefits, obviously, with free shipping is the express delivery and fast delivery services. That was up 60% year on year. And we are really excited about the proposition. Having Walmart Plus with Seth Dallaire move to an enterprise level, we see room to expand this into more markets in the United States, and we're working on those plans. But overall, membership in Walmart has been strong. Sam's Club also had great results with membership in the quarter. We see continued momentum there, which would include Sam's Club in the United States and Sam's Club in China. We talked about that earlier. So really strength across all these areas. The other thing I'd say about membership is it does give us a chance to serve customers really frequently. And again, when you combine membership with the work we're doing with agentic commerce, whether that's with Sparky or partnerships with Alphabet or OpenAI, it just gives us more ways to be able to understand the best way that our customers and our members want to be served.
Thank you. This now concludes our question and answer session. I'd like to turn the floor back over to John Furner for closing comments.
Yeah, thanks everyone for the time and the investment and time in Walmart today. It's great to have you on the call. I just want to close by saying we have a clear strategy, and that's an omni strategy. It's working in the United States and it's working around the world. We see a lot of opportunity to expand what we've built to serve customers better, both here in this country and around the world. We have a great team. This is a really experienced leadership team. You heard from a number of those people today. And while they're new in their roles, I can tell you each and every one of them care about our associates. They care about our culture. They want to grow, and they're really experienced at the things they do. So I have a lot of confidence in this team as we look ahead. Our capital strategy, I'm also really pleased with the investments that we've made. We'll continue to remain disciplined on how we invest capital. John David said it earlier, every dollar will compete for the best returns. That is true and will remain true. And then finally, I just want to thank our associates all around the world, over 2 million people who are working really hard each and every day to serve our customers. They're the ones that make all this happen. Our people really do make the difference. And I'm looking forward to a great year and getting out to the markets and meeting more of our people.
Thank you. Ladies and gentlemen, thank you for your participation. This does conclude today's conference. You may now disconnect your lines at this time.
Okay, that was the full Walmart earnings. What I'm going to do is I'm going to put two links up above. One was yesterday's FOMC minutes. We gave the full analysis. You want to watch that, and there'll be a playlist up here. The newsletter link down here. You get a free trial. Now we're going to go on to the US versus Iran. Actually, I'll put that instead of the playlist up here. So let's go on to that video. But until next time, take care of yourselves and each other.